Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. His website, macbethmcleodgroup.com. You can find him on Twitter at HMacB. Welcome back to the show, Hilliard.
Nice to be back on the show.
Hilliard, before we went to air, we were talking about some interesting anniversaries. It was a year ago today, the stock market bottomed out. What's the result been, and is it going to do the same thing again this March?
Well, so the decline last year, after COVID became real, starting about February 20th, bottomed out in, I think it was mid-March, after a 37% decline. But the big one was 12 years ago, March the 9th. So as we speak today on March the 9th, it was the bottom of the market 12 years ago after the global financial crisis. And the S&P 500, which is, of course, the biggest benchmark in the world, the U.S. stocks, hit 666 briefly on that day. So I remember that. And today it's threatening to touch 3,900. The peak was hit a few weeks ago at about 3,980 points. So it's about a six-fold increase, not quite a six-fold increase in 12 years. It's one of the biggest runs in the stock market ever. The 1918 to 1929 run was pretty significant as well. And of course the big one leading up to 1999, 2000 was also very big. So it's one of the top three probably. And it's very long. 12 years is very long. The magnitude is very, very large. And the weird thing about this time is we're close to peaks in the middle of the most severe recession since the 1930s. So that has never happened before. So this one's unique in that sense that it's not in sync with the economy, unlike the previous two that were happening during a pretty strong economy in 1929 and 1999.
Is the difference this time around governments have been throwing out billions, in the case of the U.S., trillions of dollars to keep things from falling apart?
Absolutely. I think that's, the money that they were trying to, I assume they were sincerely trying to get it into the hands of the average person to help them out, because the recovery since 2009 has actually been quite anemic in the real economy, as they call it. All that money that they crammed into the system basically made its way into housing and into stocks, but it really didn't make its way into employment. In fact, the employment numbers are abysmal. And that was they weren't that great before COVID, and of course since COVID they've gotten much worse. So the long-term employment, and of course listeners will know that the unemployment measure is a very flawed item, because they ask people if they're looking for a job, and if they say, no, I'm not looking for a job, then they don't get counted as unemployed. So in COVID, there would be no point in looking for a job in COVID, because, people got their doors closed and, people were working from home. So where would you even go to look for a job? So, that measure is extremely, poor measure right now. So if you look at the actual percentage of the labor force that's employed, it's at a record low level, down around 61% compared to an average of 65-66%. So by that token, by that measure, this is really bad economy, and yet we have a very strong stock market, and valuations are at record high levels.
The tech stocks have lost about 20% since their peak in February. Are they going to continue to slide?
Well, it's hard to say. They're extremely overvalued. So I was looking at, today I was looking at growth versus value stocks. And of course, most of the tech stocks would be in the growth sector. Like one really stands out as price to sales ratio. So much higher than 1999. It's just, people are paying multiples of sales, which are crazy. And of course, what that means is they're expecting phenomenal growth in the company's sales in order to grow into the valuation. But in past peaks, that's never worked. I remember in 1999, people say, yeah, but the internet is going to change the world and all these stocks will be perfect. And of course, it turned out that the first part was correct. The internet did change the world, but paying that much for the stocks, the way they were trading in 1999, was a big mistake. And, for example, Amazon in 1999 was trading at $60, and 20 months later, year and a half later, it's trading at $4. So it went down something like 90%. Now it's trading much, much higher, so it would have been okay to hang on. But how many people can stand a decline like that? So stocks like Tesla right now, which hit 900 in January, are now down in the 600 and something range, and I think it actually went below 600 briefly. And there's a bunch of other stocks like that have done the same. So 20-30% declines, and of course people would jump in and say, "Oh, it's a bargain," but it may not be a bargain. If the Amazon example in 1999 is valid, the correction in tech stocks and growth stocks could be much bigger than what we've seen so far.
I mean, I've heard some analysts say, we could be in for a 60-70% reduction in stocks.
Well, yeah, and one of my favorite gurus is Jeremy Grantham, who I met in 2003 at a conference in New York. He was the keynote speaker and one of the keynote speakers, and he just came out in January with a piece which I highlighted in my weekend note, which people are welcome to look at for free. And he said that he's expecting an epic bubble, and he's expecting an epic correction, which by that measure would imply in the high-flying tech stocks 70-80% correction. Maybe the overall market might correct by 50%, as happened between 1999 and 2002. But the tech stocks, the NASDAQ, went down. I think it was 5,000 was the peak on NASDAQ, and it hit below 1,000 by the time it was finished correcting. So what's that? 80%.
Yeah. Do you agree with that, or is it just an interesting theory?
No, I think that's probably accurate. I mean, I don't know about the 80% part, but I do know that the stock market bubble. Of course, I wrote a book about the real estate bubble bursting, and that hasn't happened yet. But at the time I wrote that book, which was 5 years ago, the first edition, the stock market was expensive, but it wasn't in what you'd call a bubble. And but since then, it's become a full-fledged, all-out, record-breaking bubble in the stock market. It'd be like basically. I've been doing this. I'm in my 43rd year, and there hasn't been anything like this. In my opinion, it's worse than 1999 because the valuations are more stretched. And the thing in 1999 was the dot-com stocks and the telecom stocks were extremely expensive, but there were lots of stocks that were really cheap, like bank stocks and mining stocks and oil and gas stocks. Oil and gas stocks were dirt cheap at the time. Today, it's different in the sense that everything is sort of either moderately expensive or extremely expensive. So it's there's no place to hide right now.
When you say no place to hide, is there? When you say no place to hide, just expect everything to lose. Are there safe havens where you can at least protect what you have now?
Well, the interesting thing, and this will be my weekend note coming out on Friday this week, is value versus growth. So we've been talking about the tech stocks in 1999 and the price to sales ratio being at record high levels and stuff. And that all applies to growth stocks. But value stocks in relation to growth stocks are at the biggest discount they've ever been at. Now, it doesn't mean they're cheap on an absolute basis because the whole market is so expensive. But for those people who need to be in the stock market, like me, we would gravitate towards the value stocks. And of course, Benjamin Graham was the father of value investing, and he was the mentor of Warren Buffett. And he's got two books that he wrote back in 1930s and 1940s. which I don't recommend because they're almost impossible to read. But essentially, he said you should never buy a stock unless it's really, really cheap. Well, there wouldn't have been any stocks for him to buy in this market. It would have been impossible for him to buy. So he died in 1976. So luckily he didn't see this. But Warren Buffett's still alive. He's 90 years old now, and he's got a record level of cash. He's got something like $160 billion of cash in the Berkshire Hathaway cash vaults. So there is an alternative. You can invest in value stocks, especially if you go outside of the U.S. market and look at Europe and other areas that are emerging markets. Or you can, alternatively, if you want to be a little bit more speculative and you have the freedom to do this, you can just go to something like cash and short-term bonds or really safe fixed income stuff and wait it out and hope that there's a correction and then you can buy in. But the history of that it usually doesn't work very well because timing is too difficult for I was going to say for most people. Timing is too difficult for everyone. So
we'll have more with Hilliard MacBeth right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Hilliard MacBeth. Crude prices have picked up quite a bit in the last little while. Is that helping Alberta, and is this trend expected to continue?
Well, when you start a year ago at less than zero, at a minus number, there's no place to go but up. And of course, now the crude price is something like $60 in the West Texas Intermediate, and there's about a $20 discount to the Western Canada Select. And the reason the discount is narrowed is the cost of transportation has come down because the pipelines are not totally full, so they're able to ship by pipe. If they have to go by rail car, they have to pay a lot more. Roughly, these numbers may be a little bit off, but the rough guideline is about $5 per barrel by pipeline and about $15 per barrel by rail car. So if the pipes are so full that you have to use rail cars, it's not a very good business to be in if the price of oil is low. But now things are actually pretty good, and of course the demand is expected to pick up as people get vaccinated. The vaccines are rolling out in Alberta. I understand in BC they're struggling, but Alberta's actually there's been some progress made, and I've actually talked to a few people that have been able to get in and get a vaccine, and next week, the week after, more and more people will be able to. So once people have the vaccine, they may go out and start traveling around a little bit and spend some money and burn a little gasoline. So that's the positive from the short term. From the longer term, I'm skeptical of the whole energy sector because the demand for oil peaked in North America about 2 or 3 years ago, and it's probably going to be dropping for the next decade or two as people move away from fossil fuels and start moving more towards renewables. And so, depending on what your time frame is, if you're a long-term investor, you might have trouble making money in the energy sector, especially after this rally that we've had.
Alberta's talking about getting into the vaccine business. Is that a good business to be in?
I don't think so. I think the problem that happened was there was difficulty getting your hands on the vaccine. A lot of the vaccine components are manufactured in places like India, and people got very upset, and the politicians got involved and all that. But a vaccine business is not a very good business. Traditionally it's been a very poor business. In fact, it's so bad that in previous vaccine attempts, the government had to guarantee to the vaccine maker that they would cover their losses because the expectation would be that there would be losses. Plus, there's a whole bunch of liability or legal liability if you give the vaccine to 1 million people, and even if 1,000 of them die, you've got a really big problem if you're the vaccine maker. So, almost for sure, I haven't seen the actual thing, but almost for sure, there's been indemnification given by governments to the vaccine makers. I looked at Pfizer, which is one of the three leading vaccines. It's based on the mRNA platform, and their stock is not reflecting the money they're making for vaccines. But the money could even though they're charging much less than they normally would because of the unusual situation, it's actually in the billions of sales, and it could possibly ramp up to a larger number. And the bottlenecks with the production will get ironed out, and people will be able to get more. But needing for the whole world, it would be 14 billion doses if everybody gets 2 doses, right? So that could be several years of production. But to go into business in the expectation of getting a piece of that, and then having to shut down a couple of years from now if there's not another virus, would be, in my opinion, be a bad business. But maybe if there's a wave of repeat, like the flu vaccine, it needs to be brought out every year, it might be okay. But if every country goes out and builds their own vaccine manufacturing capacity, then it's not going to be a very good business to be in. No, you need to be one of the big centers that's shipping all over the world to make money on something like that.
We'll have more with Hilliard MacBeth right after this.
AVN Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AVN's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avnresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, it's been 2 years since the federal government did a budget. Is that important?
It's absolutely mind-boggling to think that we haven't had a budget for more than 2 years now, and it's not clear when we're going to get one because there's only a limited number of days between now and I guess it's June when they break for the summer or whenever they do that. It looks like there will be a budget though because I was checking just today, and Chrystia Freeland was talking about the consultation period that they normally have. And a couple of weeks ago, she made her famous quote. Actually, 1 week ago, she made her famous quote, which was, I wrote it down, what it takes as long as it takes. So she's saying something similar to what Mario Draghi said in Europe about 8 or 9 years ago when he said, we'll do whatever it takes. And of course, he was talking about monetary policy where you flood the market with credit through the banking system. But in this case, what Chrystia Freeland, the finance minister, is talking about is the government actually spending money, and the numbers are mind-boggling big. $400 billion deficit. So we were looking, before this all happened, we were looking at maybe a $20 or $30 billion deficit. The current government wasn't talking like the previous government about balancing the budget. They were talking about being willing to run a deficit, but nothing in the hundreds of billions. So a couple of years at $400 billion, you get pretty close to $1 trillion pretty fast. And the good news is the federal government actually started out with a very low debt level as a percentage of GDP. It was only about 30% of GDP. But before this is over, if we ever see another budget, I'm sure we will at some point, it's bound to be $1 trillion. So basically, it's probably going to at least triple in a very short period of time. It's bigger than what happened in the U.S. because, of course, in Canada we replaced all of the lost income that people had lost when they lost their jobs due to COVID, and plus another big chunk above that. But they didn't do that in the U.S. But at the end of the day, assuming that things go back to some sort of normal with the vaccines, we will now be quite comparable to the U.S., where the debt was roughly equivalent to about 80-90% of GDP, if you include in Canada's case, if you include the provinces.
I read an article that said you should do intense tax planning this year, get every break that you can squeeze out, because the government's going to have to make up this money somewhere, and that usually means higher taxes.
You know, it would be a great interview would be to do modern monetary theory with Stephanie Kelton or somebody like that, and because they insist that you don't have to ever tax it back. The reason you would tax it back is the deficit. I mean, is to avoid inflation, and inflation is a big worry. When the government pumps $400 billion a year into an economy the size of Canada 2 years in a row, and there's a shortage of this, and there's a shortage of that, and there's a shortage of all kinds of little things. You know, the obvious thing for people to do that have stuff to sell would be to raise their prices, and then you get inflation. So the inflation measure, like the other measures that we talked about a minute ago, are very flawed, but they would start to rise, and then you'd end up with rising interest rates and all that kind of stuff. So the way to avoid that would be to raise taxes on people that consume a lot, and that would slow them down and bring the inflation rate back down again. But I don't know if people have the stomach for that. It'll be interesting. They'll probably try and raise taxes on the rich people, and certainly I know in the business I'm in, I know quite a few of those people, and they are very worried about taxes going up next year. There's one in particular that affects investors, and that is the capital gains tax. So it's currently at 50% inclusion. So if you have a $1 million profit on your Tesla shares, let's say, for example, you only have to include $500,000 of that into your income tax. And if you're in the 40% tax bracket, then you'd pay $200,000 in tax. So you still get to keep 80% of the $1 million gain after paying $200,000 in tax. So that 50% is the lowest inclusion rate we've had since going back to the 1970s, and it's been higher. It's been 75%, and it's been 66 and 2/3%. So at one point, I think it was at one point 100%. That wasn't recent. I think that was quite a ways back. So that would be one that would be a worry, would be that they might decide to do it. And I would hope that what they would do, to be fair, would be to say, you know, your first $1 million, we won't charge you that increased tax rate, but on lifetime gains above, let's say, $2 million or $3 million or something, then we'll make it 100% taxable. You know, they'll probably get advice saying they shouldn't do that because all the rich people will leave Canada, but they may try it anyway. I don't know.
Does Canada have that many rich people?
They must. I think we must. I don't know, but yeah, I hope they don't all leave because we're still waiting for it to trickle down, right?
Yeah, since the 80s.
It hasn't trickled down since Ronald Reagan and Margaret Thatcher told us it was going to trickle down, and it still hasn't trickled down. It seems to actually be going the other way. It seems to be trickling up, but that's another story, I guess.
Well, all the billionaires who made all these extra billions during the pandemic.
Yeah, well, that was a function of the stock market. So the thing about billionaires and rich people is that they generally tend to own most of the stocks. And the little guy, or even the middle guy, the average guy, they don't have very many stocks other than maybe in their RSPs or in their pension plans. But by the time they finish buying a house, paying off the mortgage, raising the kids, you know, paying the car payments and all that kind of stuff, how much money is actually left over to put in the stock market? Not very much. So it's generally the rich people. The stock market went up a lot in the last year. So it's unfortunate, but it's very unequal. And I think it could lead to big problems down the road if it's already extreme in the discrepancy, and it could cause a breakdown in the social fabric or social cohesion or whatever that term is.
Somebody suggested REITs might be a good investment, but that was a person in the U.S. Is it a different story in Canada?
Yeah, I think it is. So the real estate investment trusts tend to own things like apartment buildings. There's a couple of big ones in Canada that own apartment buildings for rental. Shopping centers, like the biggest REIT in Canada is called RioCan, and it owns primarily shopping centers. They're desperately trying to rebrand themselves as being something else other than shopping centers, but it's not that easy to do. And office towers. So there's one called Dream that owns office towers. There's a couple other H&R REIT owns office towers. Terrible businesses in Canada. I mean, it's just absolutely shocking how much trouble people are having. But interestingly, the REITs are able to continue, some of them are able to continue to make their payments. So the whole thing about REIT investing is the payments, the monthly payment. They all pay monthly, and they all give probably a too generous payment, which attracts people to them. And then they desperately have to figure out how to get that money to pay it out. And a lot of times they pay out more than they should be paying, and they use borrowed money in order to pay that out. So if something like a pandemic comes along, they just get into real trouble. And that's why you saw the share prices of the REITs go down a lot, because investors correctly realized that some of these REITs could be in trouble. In the U.S., it's worse in the sense the shopping centers they had way more shopping centers than we had. So any of the REITs that were in the shopping center business went down even more, and they haven't recovered as much. So that may be why the person in the U.S. was saying they're a bargain, but I would be careful, because these, for instance, our West Edmonton Mall guys, 555 that own that one, they're in big trouble in their malls down in the U.S. They've got one in Minnesota, and they've got one in New Jersey, just outside of Manhattan. And in both cases, they've got debts that they are unable to pay. So they're actually, in the U.S., actually talking about jingle mail, which we tend to associate with people turning the keys of the house back to the mortgage, the bank that gave them the mortgage. But in this case, the owners of shopping malls are giving the keys to the shopping mall back to the lenders. So there's a whole industry that's built up around managing these loans and managing these shopping centers. They have no way of managing the shopping centers, or the lenders don't know how to run these things, so they'll have to probably hire back the people that defaulted on the loans to run it for them.
What's going to happen to shopping malls? Because if you go into so many of them right now, they're more than half empty. Are they going to be able to recover?
No, I don't think so. I think it's been a. I think you and I talked about it maybe a few months ago, but I went to a conference in 2006 or 2005 in New York, and he was the analyst that covered shopping malls, and he said we're way overbuilt. And so a couple of years later, I was back at the same conference. The same guy was presenting, and I said, and then they had the global financial crisis in the meantime, and I said, what happened? I asked him what happened. That, like you said last time, he said they were way overbuilt. He said they kept building the shopping malls all the way through the global financial crisis. They kept building, and he couldn't believe it, because they measure it by how many square feet per person, and it was way off the charts. It had gone from something, I don't know what the numbers were, but it had gone, say from 8 square feet per person to 20 or something like that. And so the follow-up question, of course, was, well, what's going to happen? He said there's only one way out, it's bankruptcy. So the only way to get out of it would be for a whole bunch of those malls to go bankrupt and then shut down and reconfigure themselves as something else. The one in Canada I mentioned, RioCan, they are talking about bringing in rental housing and a bunch of other things like community centers and stuff, but none of them would pay like a shopping mall paid at the peak of the shopping craze. But there's a whole thing with it's so much easier to shop on the internet from home. You push the button, and a couple of days later it shows up. You don't have to go and fight the crowds, unless people are really, really desperate to get out of their house, which there are some people like that. If they live in a small apartment or something. The attraction is a little bit hard to see. The new one that the 555 people are in trouble with in New Jersey, they have all of these attractions that they had put together. I think an indoor ski hill and stuff like that to get people to come out. But I don't like that business.
Well, you have one of the biggest malls in the world in the West Edmonton Mall. How are they doing through this, and are they going to have to make changes?
Well, they have a debt. They refinanced themselves after the global financial crisis. When the bond market opened up again, they were able to refinance themselves with about $1 billion in debt. And I don't know what's going to happen to that, because Alberta, of course, as everybody knows, is in a slump. Apart from COVID, Alberta was already in a slump, and so because of the oil. So I don't know what's going to happen. The valuation on that mall 25 years ago was about $300 or $400 million. The valuation at when they got it refinanced obviously was over $1 billion. I don't know if it's worth $1 billion anymore. I doubt it. So, I mean, I don't know. I'm not in the shopping mall business, but I suspect they probably have to get refinanced again, and the lenders may have to take a haircut. They call it taking a haircut in the junk bond market. But there's so many stories like that. I mean, there's just literally hundreds of stories like that. One of the biggest owners of shopping malls is actually another Canadian company called Brookfield, and they own a bunch of them in the U.S. They had a partner, and they ended up buying out their partner, or I forget exactly how it works. And another one was Simons. So you could certainly find out more about what's happening with shopping malls by going and looking at Brookfield and Simons in the U.S. and seeing what's happening there. But the way out, there's really just the one way out is bankruptcy, and then if somebody could figure out a use for these things other than a shopping mall, they would be very they'd have a really good thing going, because they could go to the lenders who had taken over the ownership of these shopping malls and make a proposal to them, and the lenders would be desperate to do something, anything, just anything, They'd probably give it to you for nothing, close to nothing, if you had a good idea.
Well, here in the Vancouver area, Burnaby's Brentwood Mall is redeveloping, and they're putting in high-rise towers where some of the anchor chain stores that have gone out of business were, like Target.
Yeah, I mean that's an interesting model, but I mean there's already been a record amount of residential real estate built in Canada over the last 10 years, so it's not like there's a shortage there. But yeah, something will happen. I don't know what it's going to be, but something will happen, and it's going to involve a lot of bankruptcies and a lot of foreclosures. And I'm sure someday somebody will come up with a great idea, because, they're usually pretty well located. Sometimes they have, transit attached to them and that sort of thing. So, there's definitely an opportunity there. Maybe cover them with wind turbines and solar panels.
Well, Burnaby City Council is proposing that, Metrotown Mall, the biggest in British Columbia, which is on SkyTrain, that they turn it into a street-level complex where instead of people walking through a covered shopping mall, it's nicely little boutique shops and stuff along tree-covered streets.
Yeah, there's definitely opportunities, but spending more money to try and keep something going is, it still probably won't be enough to pay back the debts that have been incurred, because the debts were all incurred at high levels, high levels of construction, high levels of purchase of the land. All of the debts were incurred with the expectation that you'd get those high rents from the shops, the highest rent being paid by the smaller shops. The big anchors pay the lowest rent, and the little guys pay the highest rent. Well, all those little guys are just absolutely devastated right now, and there's no evidence that it's coming back for them. So they can't. Most of them couldn't afford to pay the rents they were paying even before COVID hit. But they were just kind of like they were in love with the idea of having a shop and having customers and all that, but they weren't really making much money. But now they just have to say, no, I can't do it anymore, and find somebody else. And of course, then it gets worse, because then if the mall isn't full, then the anchor store doesn't have to pay its rent. And the Hudson's Bay Company is in a big legal battle with a bunch of malls right now in Canada over exactly that issue, whether they have to pay their rent or not.
Hilliard, thank you so much for chatting with us.
Nice to talk to you again.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, macbethmcleodgroup.com. If you have any questions for Hilliard or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @Housestreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.